Hi guys, it's Thiru here, founder of Master the Markets. Just a very quick training video on risk management, one of the most important topics of financial trading. Now you see, some of you might have already looked at this video in our Trader Starter Pack, and for some of you who haven't, some of you have, this will be a very good reminder video, because remember, to be a master in anything, repetition is the key. Now in this video, what I'm really going to explain is that because most people will come to us and ask us, Thiru, I like kind of trading, I would like to explore it, but kind of fear because I think that trading is risky and it's gambling. And you see, what I usually tell is that yes, trading is risky and gambling if you do not risk manage, okay? So that is why this is one of the most important topics of trading. And this is what we're going to explain in this video. In fact, how you can cap your risk and you do not lose your profits, and so that you can make consistent profits in a very safe and secure way. To explain that, let's take a look at this Traders Basecamp video where we actually explain this to front of a big audience. So how much would that be? So that's good, you're all awake, that's great. Okay, so £100 divided by 200 pips, how much would that be? 50p, that's right, 50p a pip. So that means to say, now take a look at this, right? So if the trade were to go up by 100 pips, how much would you make? No? By 100 pips. Let's say you put 50p a pip, right? And if the trade were to go up 100 pips, how much profit would you make? £50, that's right. You see, every pip that it moves up, you make 50p, right? So 100 pips, you will make £50. But now look at the reverse side. If it went down by 100 pips, how much would you lose?
£100 because 200 pips.
No, 100 pips it went down by. So 50p a pip. If it went down by 100 pips, how much would you lose?
No, you can't use it. 200 pips.
No, I'm just up. £50, that's right. But however, if it went down by 200 pips, how much would you lose? £100. So at that moment, when it goes down by 200 pips, the broker will take you out because your stop loss is there. So you can see by doing this, effectively what's happening is that you are capping your loss to a maximum of 200 pips, or at 50p a pip, £100. Therefore, effectively in every trade, you're only risking how much? 1% of your account. This is how you cap it, using position sizing. Do you all get that? Who didn't get that? Who's got questions? Yeah, James, what's the questions you got? Okay, yeah. Okay, everyone understands this, right? £10,000 your account size, yeah? You got that, yeah? Okay. The second part is account risk. Is everyone clear with that you only risk 1% of your account? And therefore that's £100, yeah? The next point is your trade risk. Trade risk, how do we find trade risk? It's usually your entry minus your stop loss. Okay? So sometimes, so let me just explain this a bit more. So trade risk, sometimes what we get is entry minus your stop loss. So entry, let's say, is 1.2550, and your stop loss, let's say, is 1.2350, okay? Right? And let's say that on a diagrammatic format, let's say it's the high of this bar, which is 1.2550, and then the low is 1.2350, okay? So if you were to look at that, you can see that the entry minus the stop loss is how many pips is that? 200 pips, yeah? 2550 minus 2350 gives you 200 pips. So your trade risk in this example is 200 pips. Are you following so far, James? Yeah? Okay, and everybody else. So then we go back to here. So we got account risk and we got trade risk. The last point is to find your position size, where what you do is that your account risk now, which is £100, you divide it by your trade risk, which is 200 pips. And what you then get is 50p a pip. Okay? So now what is the advantage of that? Everybody okay with the calculation so far? That's pretty straightforward, right? Yeah? Okay. So, what is the advantage of doing it now, of getting 50p a pip? Now, you have now position size. So, this is your position size, okay, that you've got now, which is your position size, which you got now, right? 50p a pip. Yeah? Now, once you do that, what happens is, if the trade were to go down by 200 pips, because your stop loss is here, once it gets down to 200 pips, your broker will take you out. Because you told him, whenever it drops to more than to 200 pips, take me out of the trade. Therefore, what you have now done is that because at 200 pips at 50p a pip is equal to how much? 100 pounds. So therefore, what you have done effectively is you have capped your loss. That's what you have done. Yeah, is that clear, James? Yeah. So whenever it drops this amount, because you have already position sized it and you found out that it's 50p a pip, it must be 50p a pip to get me 1% of the account. So mathematically, you have covered yourself and you have capped your loss. So that's called position sizing. Is that okay? Yeah.
I trust that you have enjoyed the video. Really lots of good information on risk management, the critical part of trading. And in fact, you see, I actually kind of remember this, which is most amateur traders, when they start off trading, they always, before they get into a trade, they always ask, how much money can I make? But however, a professional trader asks, how much money can I afford to lose? And that is a trader who has mastered risk management. And I believe from this video you've understood that and understood the basics of proper and efficient risk management to keep you safe and secure on the markets and to make consistent profits. We look forward to seeing you in one of our Traders Basecamp workshops. Until then, always keep trading like a master.